Welcome everybody to the 2021 webinar series. Thank you to joining us. It is a pleasure to have you here today. As you may know, Thornton, Costa Rica runs a series of webinars during the year to inform our clients on how businesses can respond to the impact of new laws and regulations, but also to provide you with practical steps and suggestions on how to protect the reputation, preserve value, and manage their activities. So, in the webinar series of the coming days, we are going to develop and try to understand how the tax administration will collect taxes. The specific topic that we will address today will be inactive companies, their definition, and obligations for the 2021 fiscal period. Before getting started, I just want to bring out a couple of things to your mind. We are going to be spending an hour approximately. You will be hearing two different speakers today, Mr. Mario Hidalgo and myself. We apologize in advance for any interruption since this is a live event. At the end of the webinar, we are going to be providing Q&A, so please feel free to look to the question window located at the side of your screen and post any queries you may have in relation to this topic. We will try to cover as many as we can. And last but not least, we will be sharing the recording and any other tools after the webinar takes place to everyone who is attending, and also the speaker's email address, so that will give you an opportunity to make contact with us directly. Though, without further ado today, let me briefly introduce ourselves. Mario Hidalgo, tax and legal partner from our firm, and I have more than 15 years of experience advising international clients in Costa Rica, being consultants to companies with various commercial remits in tax, customs, agriculture, real estate, software, among others, and has participated in various procurement procedures and business model structuring projects at both the local and the regional level. So, Mario, good morning.
Good morning, Ivannia, and thank you very much for this opportunity. And I want to greet all the people that are participating in this webinar, and more than glad to be today in this event. And Ivannia and myself, we will do our best to try to share our thoughts and information regarding this important issue. Good morning to all again.
Let's get started. As I have mentioned before, today's topic is inactive companies, their definition, and obligations for the 2021 fiscal period. In this regard, we will be covering the following content. What is meant by an inactive company? Changes incorporated by the law for the strengthening of public finances, obligations of inactive companies, case studies, and some recommendations. First of all, we need to understand what is meant by an inactive company. In accordance with laws in force, they correspond to those companies constituted in the country that do not develop profitable activity of Costa Rican source, being the tax administration perfectly able to determine the way in which those companies will have to comply with their formal obligations. Taking the above into consideration, we must clarify two concepts that are particularly important in this regard. First of all, what is considered a profitable activity? In accordance to our current laws, is any activity of a business and/or professional nature consisting of the organization on one's own account of the production factors and the human resources or one of them, with the intention of obtaining profits through participation in the market for goods and services. And second, what is interpreted as a Costa Rican source income? Due to the content of the income tax law, income, revenues, or benefits of Costa Rican source shall be understood as those generated in the national territory from services rendered, goods located, or capital used, which are obtained during the fiscal period in accordance with the provisions of this law. Bearing in mind those definitions, we have to clearly identify which companies must comply with these obligations and will be mainly those regulated in our Code of Commerce. I mean, companies in collective name, limited partnerships, limited liability companies, corporations, foreign companies, and branches. So, for all the above mentioned corporate structures, the law for the strengthening of public finances has incorporated some changes to take into account. Being the main one, the amendment of Article 2 of the Income Tax Law, which refers to the meaning of taxpayers. Before said amendment, Article 2 established that taxpayers were those legally constituted legal entities, de facto companies, professional activity companies, estate companies, and joint accounts in the country. Nowadays, Article 2 defines taxpayer as all legally constituted legal entities, regardless of whether they carry out a lucrative activity or not. Consequently, we have that the obligations of inactive companies prior to the new regulations could basically be listed as the following. First, the annual payment of the corporate tax. This tax must be paid between January 1st and January 13th of each year, and non-payment in time carries interests. We have also to consider that non-payment for 3 consecutive periods provides the government the possibility of automatically dissolving the company, regardless of whether it has assets and or other legal obligations, which may result in additional complications for the shareholders of these companies. The second obligation is the annual payment of a stamp of education and culture. We have to remember, too, that all companies with or without economic activity must pay this stamp annually during February and March. The amount is calculated based on the income tax declaration. However, in the case of companies that are not taxpayer of this tax, I mean inactive companies, the payable amount will be the minimum established by law. The third one, submitting the annual declaration of Registry of Transparency and Final Beneficiaries. This is also a new obligation, since the companies have complied with submitting this declaration just in 2019. Notwithstanding, such declaration must be filed ordinarily once a year between April 1st and April 13th. Legal entities incorporated before or after April have 20 days as of the date of incorporation to comply with the ordinary declaration filing. Extraordinary declaration filings must be submitted within 15 days after any change in share participation greater than or equal to 15% takes place, or when a final beneficiary is included or changed. It is important to emphasize that high fines apply for non-compliance, and that the government is actively pursuing the application of these fines, and lists of non-compliant companies have even been made public as a last call warning. The list of delinquent companies with this obligation is available on the Tax Administration website. And at the last, solidarity tax payment. Its objective is to obtain resources to finance low-income housing. The triggering event is the ownership of real estate for residential use that is used on a regular, occasional, or recreational basis, including fixed and permanent facilities. The obligated parties are the registered owners of such real estate. The obligated party must register the property subject to this tax on the tax administrator platform or portal. This must be done only once. And the declaration of the value of the property must be filed under the parameters of the Unit Base Values Manual by constructive typology and the parameters of the maps of land values. There is an obligation to file this declaration every 3 years, no later than January 15th of the corresponding year. It must contain the indicated parameters to determine the subjection or not to the tax and the taxable base. The declaration is filed through the Form D-179 and the non-presentation entails a sanction of 15% of the salary base. The current triennium updated in 2019 covers 2019, 2020, and 2021. Okay, now, in addition to the 4 obligations already mentioned and detailed above, inactive companies must comply with their registration before the tax administration. Under Resolution DGT R 075/2019, companies and corporations that do not carry out lucrative activities in the country are obliged to register in the single tax registry under code number 960113. The process is carried out using Form V-140. The tax administration opportunely scheduled compliance with this obligation according to the last number of the corporate ID, as we may see in this slide. In spite of the pointed obligation, ex officio registration may apply. So those companies that at the time of the effective date of the referred resolution are already registered with the information of legal representative and fiscal domicile will be assigned with the mentioned activity ex officio. However, those registered ex officio for the first time must file within 1 month from the date of registration the corresponding form updating their data. Failure to comply with this obligation leads to fines of a 15% of our base salary for each month or fraction of a month, without the total penalty exceeding the amount equivalent to 3 base salaries. These legal entities, these legal entities registered with the tax administration under the Economic Activity Code 960113 shall not and cannot issue electronic bills. We have to keep this in mind. And they must file income tax return by Form D-101 through the virtual tax administration system. Besides Resolution DGT R 075/2019 establishes that all inactive companies must file the asset declaration for inactive legal persons. This will be done using Form D-101, and the minimum content of this declaration must be assets, liabilities, and equity. The assets, it's gonna be understood as a resource controlled by the entity as a result of past events from which the entity expects to derive future economic benefits. Maybe real estate, movable assets, securities, or intangible assets even. Liabilities is going to be a current obligation of the entity arising from past events at maturity of which, and in order to settle it, the entity expects to release resources embodying economic benefits, and maybe documents to be paid or accounts payable. And last, equity. That is the residual part of the entity's assets after deducting all its liabilities, including share capital, extraordinary contributions, surplus from revaluation, profit for the period, retained earnings, and expenses. The period to comply with this obligation is within 2 months and 15 calendar days following the close of the fiscal year. For the fiscal period to 2020, which ended in December 31st, the reporting period will expire on March 15th of this year. Failure to comply equivalents to a penalty of 2% of the gross income of the previous fiscal period, with a minimum of 3 and a maximum of 100 base salaries. If the amount of gross income is not known, the penalty is going to be equivalent to 10 basic salaries. The administration is also authorized to request from the taxpayers the information it considers appropriate to carry out the control and inspection process that it's his responsibility. And now Mario is going to talk a little bit of these auditing processes to us.
Thank you very much, Ivannia. It was a very clear presentation. Now we have learned throughout this event what we should understand as an inactive company and which are the formal obligations that the shareholders of an active company should comply with in order to avoid penalties and other consequences established by the law. Nevertheless, this is the tip of the iceberg because this is what the tax administration is trying to accomplish here is not to try to impose penalties and other consequences to the taxpayers. At the end of the day, what the tax administration wants to know is where did the shareholders obtain the resources to purchase the assets that are in the name of such companies. And basically, that is what we understand as an unjustified increase in the equity of the taxpayers. So the main idea about this new obligation that Ivannia clearly explained is to try to find out or determine where the different economic resources were obtained by the shareholders of the entity in order that those companies will be able to purchase those different assets. And basically, what at the end of the day, what they are trying to audit is the taxes on capital gains, which have become mandatory here in Costa Rica since the last tax reform regarding income tax law, which is enforceable since July 1st, 2019. So basically, that's the master plan that the tax administration has in mind. And also, they want to see if any movement regarding assets of the shareholders could eventually trigger other taxable events as the property transfer tax. So basically, taking this in mind, uh, all taxpayers that have or are shareholders of an inactive company, as Ivannia explained before, will have to file an informational tax return before March 15 of the current year. So at the beginning of this session, we mentioned that that is only the beginning of the issue because after that declaration, informative declaration has been filed, the tax administration will take the task to review each and every one of those declarations to see if there is a possible unjustified increase on the equity of the company. So we are going to review certain or the more common scenarios in which this situation might be considered by the tax administration as a increase or an unjustified increase in the equity of the company, said company. And also we are going to comment briefly how are the possible scenarios that we can use to amend or somehow provide or generate the proper documentation to proceed as instructed by the tax administration. So we are going to talk about a company that somehow has inherited by its shareholder property, also a company who has recently purchased a vehicle for a shareholder using a loan, and the third one is having an investment abroad. And please keep in mind that in many cases, what we have seen in practice is that in many cases, shareholders purchase assets, make investments, or receive economical benefits from third parties, and they normally include those benefits in the equity of a company that they have control over. Throughout many years, that has been a common practice here in Costa Rica, and we have seen in many cases how it's almost customary for most shareholders in our country, regardless of the fact that they are local or foreign, to have their assets owned by a company that they control. And due to this practice, also in many cases, we have found out that not all companies keep a accounting system in place that might explain where the resources came from to purchase those assets. So the idea is, if you are in or have this or have been included in one of these mentioned situations, the idea is to generate the proper documentation in order to avoid further issues with the tax administration. Remember that filing this inactive informational tax return, it's only the beginning of a process that at the end of the day might trigger an audit against the company or the shareholders of the company if we don't have or we are not able to show the proper documentation to justify the assets that are currently owned by the company. So as I was mentioning before, in the first scenario, we have an owner company that owns land that has been inherited by its shareholder. So basically, we have a shareholder that owns a corporation, and that land is basically included in the equity of that corporation. And basically, in this example, what we have is that the taxpayer recently inherited a piece of land due to the death of a family member, and he instructs the judicial procedure that was used in order to establish as he or she as an inheritor of that property to receive the land from the inheritance, in the corporation. So this is a very common situation, and as we mentioned before, if we have not been using the correct accounting information, we will encounter certain issues regarding. So what can we do in order to comply with the law and be able to show or generate a reasonable explanation for this particular scenario? So we are going to basically remember that the company owns a piece of land which was acquired by the shareholder through a family inheritance. So again, the idea is, if eventually this company in this hypothetical scenario is chosen by the tax administration to suffer or support an audit from the tax administration, it will be important to keep at hand the deed of transfer of the property to the company that shows the ratification of the extraordinary contribution of the capital in a shareholders minute meeting. So the basic idea is to, based on that deed, the shareholders will have to hold a extraordinary meeting, establishing in that meeting that a contribution of that piece of property, of that piece of land, will be contributed to the company. So it's very important from the legal side to have both documents at hand. And also for the justification of the asset origin, we will need any official document indicating the assignment of the testamentary rights of that piece of property to the specific shareholder who has contributed that piece of land to the company. And also we will have to, at the same time, recreate all the necessary steps from an accounting standpoint in order to generate the accounting information that completes the legal steps we just described. So the question that might arise is, what value do I assign to the land for accounting purposes? And basically the answer to that question will be the fiscal value included in the national or shown by the National Registry if that information is available. In other cases, we will be or we might be using the services of an appraiser that can offer us a value for that property of land. But basically, the right course of action will be to use the value included in the National Registry. From accounting standpoint, this specific slide shows how, from an accounting standpoint, the information should be showed in a financial statement generated by the end of the corresponding fiscal year. And again, this example refers to a company that owns a piece of land which was acquired by a shareholder through a family inheritance. Please keep in mind that the company was not the entity that directly inherited the piece of land. It was basically, this piece of land was placed on the number under the name, I'm sorry, of the company by the individual that received that property from the judicial process or the testament that was used for the distribution of those assets. So basically, in this slide, again, what we are trying to show is how the accounting information must be shown properly in order to complete the legal steps and documents that we described in the prior one. And this additional example is another typical one in which the owner of a company currently has on its name a vehicle or any type of movable asset purchased directly by the shareholder. So basically, again, if we are audited by the tax administration, if we don't conduct the proper steps, we will not be able to show the adequate information, and that might trigger an unjustified increase in the equity of the corporation in this hypothetical example. So the first thing, or the scenario we are talking about in this specific slide, is a shareholder that sells a piece of land that he owns and in his personal capacity. With the money from this sale, he decides to purchase a vehicle that is going to be placed under the name of a corporation that he or she controls on 100%. So how do we manage to show from a legal and an accounting standpoint which are the necessary information that we can share eventually with the tax administration if an audit process is conducted regarding this company? Because again, the money for the purchase of the vehicle was generated by one of the shareholders, which was generated as well by the transaction regarding a property that that individual used to own prior to the transaction. So the first thing that we have to do in this particular case is to find which are the documents that will support this specific transaction. Basically, the first step will be to identify the deed, public deed that was drafted and refers to the transfer of the vehicle to the company. That, if we have that documentation, we will be able then to gather the necessary additional information in order to proceed with the recognition or ratification of the extraordinary contribution of the capital in the shareholders meeting. So we have to hold a meeting and say that the vehicle or the money used to purchase the vehicle has been contributed to the company. And under that particular scenario, we will be able to show the proper justification of the resources that were used to purchase the asset. We cannot use the contribute the property that was sold in order to generate the resources or the money itself, because basically those were transactions conducted by the individual and not by the company. So also we will need to have as additional support documentation or backup documentation, the public deed of the sale of the property and the bank's transfer of the collection or bank statements that show where the money came from. So the question that might arise in this particular scenario is, what value do I assign to the vehicle for the accounting purposes? So we will use the book value. Basically, that will be the preferable reference in order to do this or comply with this formal obligation. Again, the idea is to try to justify from the company's standpoint where the money came from in order to have that particular asset, which is in this hypothetical example, the vehicle that now is under the name of the corporation. And basically repeating the same exercise as before, we have here in this particular slide how the financial statement for the end of that fiscal year should look like in order to comply with the said legislation. So the vehicle is recorded for its book value while recognizing the extraordinary contribution of the capital. So we have in the different accounts the different values, but we have money in the bank, in the accounting banks of the company, which is normally the capital contributed originally by the shareholders, now the vehicle, and we have a total of assets of 260,000 local currency colones in this particular example. And the equity is share capital, 10,000, the extraordinary contributions, which is the vehicle, and the total equity will be the same amount as the asset in this particular case. So again, this example is trying to generate the proper documentation in order to justify where the company, how the company was able to acquire this specific vehicle, even though the one that purchased the vehicle directly was one of the shareholders, which in this hypothetical example is the person that, or the individual that controls that specific company. And in this another example, we have the case in which a vehicle is acquired by a bank credit and cash contribution. The background of this specific scenario is that the purchase of the vehicle by means of a credit and shareholder contribution in cash. So in this particular case, the difference from the one we showed before is that it's a bank credit involved in order to do so. So again, if we review the financial statement that should be produced at the end of the fiscal year, we have in the assets, as using the same information as before, and in the bank accounts, we have 10,000 colones, the vehicle 250,000, and a total of assets. From the liability side, we have a document to be paid, which is the credit that was acquired in order to purchase the vehicle. And we have a total liabilities of 150,000 colones, local currency. That's the loan agreement with the bank. In this particular case, the loan agreement should be in the name of the corporation. And if this was not the case, then we have to petition before the bank to change the creditor of the loan. So at the end of the day, we have equity. In this particular example, the share capital is 10,000, which was, I'm sorry, the money that was contributed by the shareholders or the shareholder. We have extraordinary contributions of 100,000 colones and total equity of 110. So the difference is made up by or it's accomplished by the liability that was acquired by the creditor with the bank that is going to help to produce the necessary amount of money to make the purchase of the vehicle. And in this particular scenario, number 3, we have a company that owns an investment abroad. So basically, a shareholder decides to provide professional services on a personal basis to a client, and then the shareholder makes a cash contribution to the corporation. The company that he controls or she controls or the individual controls receives the cash contribution and makes an investment abroad. That in this particular case, we are talking about a Panamanian jurisdiction, but could be any other country around the world, and that should be the correct steps in order to justify how the investment is now under the name of this corporation. So which are the steps that we need to follow in order to comply eventually with a adequate explanation to give to a tax administration, to the local tax administration, in case an audit takes place. So basically, what we are talking about is that company A owns a financial investment outside of the Costa Rican territory. The money for the investment comes from a contribution of the shareholder of the company, which this individual obtained from performing or rendering services as an individual with a profitable activity outside of Costa Rica. So what do we need to provide the transaction with the correct support? Well, we need the money entry to the bank accounts, the recognition or rectification of the extraordinary contribution of capital in a shareholders meeting minute. The shareholder is the one, and the company has to include in the legal books this contribution made by these specific shareholders. And the justification of the asset origin will be the income tax return for the individuals with a profit-making activity, proof of the investment made abroad. This is very important in this particular case, due to the fact that in Costa Rica we follow a territorial principle, and basically those services rendered abroad might trigger a Costa Rican taxable event if somehow the tax administration can manage to link or somehow relate that those fees received by this individual in this particular case with its economic structure within the Costa Rican territory. So just bear in mind that in some cases the tax administration might say or be tempted to say that the money was, even though it was generated abroad, is related to the economic structure of the taxpayer here in Costa Rica, and in their opinion, that will trigger the payment of income tax in Costa Rica. Nevertheless, the important thing is to have in place that or have access to the documentation that shows that those fees were duly and properly reported to the tax administration, and the correct tax treatment was applied to those fees that were received by the shareholders. So what is the treatment of the income received? Well, income that is not taxable because it is a form of an extraterritorial source will not be subject to taxation in Costa Rica. Nevertheless, we have had some differences with the tax administration position in regard to this specific tax treatment. But again, that will be basically what we have to have at hand in order to eventually comply from any information requirement posed by the tax administration within the boundaries of a tax audit if it is conducted eventually. And basically, again, I'm going to review the facts of this specific case. Company A owns a financial investment outside of the Costa Rican territory. The money for the investment comes from a contribution of a shareholder to the company, which he obtained from rendering services as a natural or an individual with profitable activity. So the investment is recorded at cost while the extraordinary capital contribution is recognized. The investment was made at the beginning of the fiscal year 2016 for an amount of $200 in the hypothetical scenario, an exchange rate of $1 for 500 colones. And the non-taxable interest income in Costa Rica and the exchange rate differential resulting from the investment in the foreign currency is recognized. And if due to the fact that the interest is being generated abroad, those interest and exchange rate differential will not trigger a taxable event in Costa Rica. So basically, from an accounting standpoint, we have here what the financial statement should look like regarding the different hypothetical dates we have provided in this scenario that we are talking about, and how do we need to show that information properly from the asset standpoint, from the equity standpoint, and from the income standpoint. And all those aspects should basically be in consistent with the information that we have gathered also from a legal and an accounting standpoint. So what we were trying to show with this example is the different steps and the necessary information that any tax payer that might be included in one of those four scenarios we just described should have at hand in order to comply any requirement of information made eventually by the tax administration if audit is decided to be conducted regarding one of the inactive companies on the name or controlled by the mentioned shareholders. Therefore, it is important to stress in this part that again, complying, as I mentioned before, with the filing of the informational tax return, it's only the first step. That is only complying with a formal obligation, as Ivannia mentioned before. But again, the real challenge is to try to deal with a tax audit if the tax administration decided to conduct it regarding one of our inactive companies. The real challenge is to have everything at hand in order to provide the necessary documentation to prove or justify the origin of the resources that were used to purchase the different assets that are currently under the name of the inactive company. So again, that's where the real work has to be done, again, complying with the filing is not very difficult. But again, the real challenge arises regarding the being able to gather all that necessary information and conducting the necessary steps in order to comply with any information requirement that could be provided by the tax administration regarding any inactive company. So, and finally, what are our recommendations in respect with these inactive companies issue? So basically, our recommendations will be as follows. First of all, please maintain support of the origin of the assets in a historical way. Make an adequate accounting, at least for the past 4 years, with their respective backups, because the statute of limitations here in the Costa Rica for companies that have been properly declaring their tax obligations is 4 years. If we have failed to comply with the formal obligations, that term will be of 10 years. Also, we strongly recommend to determine the contributions by the shareholders and analyze the company purpose. What assets do I have? What is the purpose of those assets, and why do I have them under the name of the specific company? And if you are not able to produce or generate the proper support documentations, it will be important to consider either to liquidate the company or transfer those assets to an active company or to a individual, the corresponding shareholders, in order to avoid any future complications. The downside of doing this is that to liquidate the company or transfer the assets to an individual, it will trigger the payment of property transfer tax, which makes the procedure very expensive. In any case, if you decide to liquidate the company because you are not in a position in which you can produce the suggested documentation, you have to liquidate the company before a lawyer here in Costa Rica, perform all the procedures regarding the legal closing, and before the electronic platform that the tax administration has been using in the last couple of years in order to comply with all the legal and tax obligation aspects at hand. So again, basically the conclusion that we can share with you, the takeaway for today will be we try to explain using certain examples how to proceed in order to generate the necessary documentation to justify the assets that the company now owns and will have to declare before March 15 in this particular year. Those are the main recommendations, and we will be more than glad to try to help you in any way we can. If you have further questions, which is the following section. In any case, in this particular slide, we have the name of the speakers and the contact information of Mrs. Méndez and myself, and we'll be more than glad to help you today if we have any questions that could be made by any of the participants, or by sending an email to us, and we will try to do our best to answer any questions or help you in the best way we can regarding these specific matters or any other that might come along, I'm sorry, regarding this tax obligations or any other that might arise. I don't know, Ivannia, if we have any questions regarding the material we just shared with the audience.
Yes, we have some questions of the audience here. The first one, what happens if my company were registered ex officio and do not file within the established period the corresponding form updating their data?
Can you come again with the second part? But which part did
Basically, they do not comply with the registration of the company. The tax administration ex officio registered, so they want to know which is going to be the contingencies.
Okay, well, basically, that's a very good question. First of all, if I didn't comply with the registration, the tax administration will do that on our behalf. And we have not seen any consequences in that regard. What it is important is to please enter the tax platform, the ATV platform that the tax administration has in place, and check which is the number that the tax administration has assigned to us. And so we are sure that we have or don't have the obligation of filing this informative tax return. But we have not seen, and there's no specific consequence or penalty or liability to do this registration. Nevertheless, in our tax code, there is a fine associated to the lack of compliance of providing in an orderly manner any change in the information of the taxpayer. That eventually could be applied by the tax administration, but up to today, we have not seen that happening.
Okay, here is important to point out if also foreigners will be able to get their information into the tax administration platform.
Yes.
Okay, the second one, your company are able to assist us preparing the financial statements, filing the correspondent D-101 form, and updating our corporate books.
Yes. We are currently providing those type of services, both from the legal and the accounting side, and we will be more than glad to help you with that.
Okay, the next one, could the tax administration audit an inactive company for transactions of a period longer than 4 years? What support documentation do we will have to provide them with?
Okay, that's an excellent question. Remember that if those assets were acquired, let's say 15 years ago, 15 years ago, the tax administration doesn't have the authority to review and try to come with an assessment regarding that specific fiscal year 15 years ago. Nevertheless, they can ask for information. They still have the right to ask for information. Nevertheless, they cannot do anything about that. So the answer to the question will be basically to gather the same exact information if those transactions took place, I don't know, 3 or 4 years ago. But again, it's basically the same steps, the same exercise we were mentioning before. But again, it's important to keep in mind that after 15 years, they don't have the authority to make an assessment. Nevertheless, they can ask for information. So it would not hurt to try to gather the necessary information in order to comply eventually for any information requirement. But again, the tax administration will not have the authority to make an assessment, but nevertheless, it will not be elegant to be in a position in which we are not able to show the necessary documentation.
Okay. How can we determine the asset values to be registered and reported in the financial statements if our inactive company have some?
Okay, we try to address that throughout the presentation. Basically, for certain assets, we will use the book value or the information in the National Registry regarding properties. Also, we can use as a reference value uh, any declarations that we have made before the uh, municipalities or the different municipalities that we have been paying property tax to. But again, even though we can use the services of an appraiser, but again, the principal source of information should be the public deed or the invoice used for the purchase of the asset. But if we are not in a position in which we can find those documents, we can use value from the National Registry, use an appraiser, or the information declared before the local municipality in every case. But basically, the most important source of information should be the public deed or any invoice that was issued containing the value of the asset.
Okay, maybe in relation with this last answer is the following question. In the past, were very common to use low values when carrying out a transaction, for example, a purchase, in order to pay less taxes. Is this still advisable? What are the possible disadvantages or contingencies?
Yes, that's an excellent question, a very good one. And yes, unfortunately, it was recommended in the past, in many cases, in order to try to pay less amount of property transfer tax, a reduced value, um, a value that was not what the purchaser paid for it, the asset was included. And basically, the main problem that we have today is if you're going to sell that asset to a third party, that will lower your base when you are going to determine the capital gain tax. That will be the main concern or the main issue because you recorded that asset on a lower value following the information included in the public deed. So the problem that this action could trigger in the future is that you will, if you decide to sell, I'm sorry, that asset to a third party, you will, at the end of the day, be paying more capital gain tax because you artificially lowered the base of the value of the asset, and due to the fact that the capital gain is determined subtracting from the price in which you sold the asset and the acquisition value of that specific asset, that will trigger a greater payment of the capital gain tax. Nevertheless, for the purposes of this presentation, that value is the one that you will have to include in the equity of the company. And unfortunately, there's no way around in changing the public deed that has been already issued by the public notary that help you with the transaction. And also we might have a problem regarding an audit in respect with the property transfer tax. But again, if that happened many years ago, that should not be a problem. The real problem will be in the future if we decide to sell, that piece of land, and because we have a lower base, that will trigger a scenario in which we will be paying more, a greater tax, regarding the capital gain tax.
Okay, also we have to take into consideration, Mario, that as of today, most of the fiscal values of the assets movable or real estate assets has been updated by the National Registry. So this is not a common practice nowadays.
Exactly. Thank you very much. That's also a very important piece of information. And I don't know if we have further questions.
Yeah, the last one. How do I justify the origin of funds when they came from savings or salaries from several years ago?
That's also a very good question. Basically, if we're talking about local income, as we mentioned in one of the examples, we need to gather all the income tax returns in which if we are talking about an individual that provides independent services, showing that we have declared and paid taxes on that income. If we are talking about a salary, well, we can ask for a certification from our employer showing the payment of those salaries and that money was subject to salary tax and those taxes were duly paid, and that will help a lot in order to support the origin of those funds. If we are talking about money that has been sent from abroad, then we need all the bank transfers that show that where that money came from, and that basically will help us with complying with this aspect. But regarding salary and other fees received by the individual locally, we will need to show that those that income, I'm sorry, was declared before the tax administration, and all the tax were paid regarding that income, and exactly the same recommendation for the case of salary, if that's the case.
Thank you very much, Maria. There's no any additional questions.
Okay. On my behalf, thank you very much for the time you have decided to share with us throughout this presentation. We expect or will be expecting that this information will be helpful to all the participants, and as Ivannia mentioned at the beginning of the event, we will be more than glad to share this presentation or the recording of this event with anybody that would like to have a copy of it. And again, we can still see the in the present slide both the emails from Ivannia and myself in order to be of any future assistance to anyone that thinks that we might be able to help them with any of the issues we just addressed today, or any other tax or legal aspects that could arise in the future. Thank you very much.
Thank you, everybody, and have a nice day.